Hi there, I'm Kevin Peterson. I'm here with Andy Larsen. You are the branch manager for the Velocity Home Loans, is that correct?
That is correct. Yeah.
Okay, awesome.
Yeah.
I've known Andy for years. He is a lender, and I'm a realtor, as most of you already know. But we wanted to just get together and talk about some different topics, interest rates, time to buy, all that good stuff, and uh, share any questions if you have any. I thought our first thing about current market conditions. I'm seeing from a realtor side, it's been a bit of a buyer's market because homes are sitting on the market a little bit longer. People aren't, having multiple bids and hundreds of thousands of dollars over asking like we've seen in past years. But what does that look like from your side?
Yeah. We've definitely seen definitely a buyer's market. Uh, Buyers are getting concessions where the seller pays for closing costs.
Yeah.
And even more importantly, right now, rate buy downs, trying to
Yes.
make the home as affordable as possible for the future buyer.
Yeah.
We had a recent experience where a client was able to get 3% from a seller.
Awesome.
And at that time, they took their interest rate from 6.5% when rates were that high
Yeah.
down to 5.99%. It ended up saving them $115 a month.
Yeah. I'll take it.
And that's what got them to write the offer
Awesome.
and so forth. But it benefited them because now that home was more in their price point
Yeah.
that they could afford.
Yeah. I always look for different things like that to try and negotiate kind of a win-win. I don't love it when just one side, wins and the other side maybe feels a little defeated. So I try to
Right.
find that win-win, but oftentimes trying to find can they pay for a 2-1 buy down. I know that was something we were thinking to talk about, but interest rates, especially with payments, a 2-1 buy down, if I've got it right, 2% down off the first year, 2% interest rate
Mhm.
reduction, and then 1% that second year or
Right.
third year.
Second year.
Second year.
Second year.
Okay.
Yep. Exactly right.
And that's done as like a one big lump sum payment at closing, right?
That is correct. Yeah. So what happens is those funds typically is negotiated for the seller to cover. That goes in almost a side account with the lender
Okay.
so
Yeah.
that the payment that the buyer starts with is much lower. So first year is 2% interest rate below. So if the rate is 6.5%, they're going to start at 4.5%. That
Great.
might save them $350 a month, $400 a month.
Yeah.
And so what happens is the lender will dip from this over here that the seller has contributed to, and the buyer gets to make this lower payment. They come here, make the full payment. So the first year, yeah, it's a 2 percentage point drop. It could be anywhere from $350 to $750 per month savings that first year for the buyer.
Yeah.
Second year, kind of cut that in half because it's a 1% drop. Now you're at 5.5% instead of 4.5. And then after the second year, year three, you start on the full note rate and
Yep.
payment
Yep.
and go from there. So
And I've coached this for a lot of folks that, getting in, it allows people to kind of get used to that payment, if you will, if you've never had a mortgage payment
yes.
before. But also where rates have been so high, it kind of gives a little reprieve that should rates dip down again in a couple of years, they could potentially refinance and not be stuck at that high rate for too long. It gives them a grace period of lower
Yeah.
rate. Yeah.
Yeah. It seems like when I talk to buyers or their agent representing them and we're strategizing, that the goal is obviously ideal would be rates come down in the next couple of years. We refinance. We never have to make that higher payment at that higher rate.
Yeah.
But if not, you're right. It gives them a couple of years to begin to get their budget and ready to go, get prepared for that future higher payment
Yeah.
and that's a nice thing too is to kind of get settled in and be able to have that lower payment to begin with. So that's usually the strategy, and the hope is ultimately be able to refinance maybe before it goes up.
Yeah. Absolutely. And something you mentioned I wanted to talk a little more on. When whenever I'm looking at concessions or discounts on a home purchase that we're trying to work with on a seller, I like to do closing costs addendums instead of just
Mhm.
reducing the purchase price. Personally, why I do that is that funds can be used for to and buy down, closing costs, a variety of things.
Mhm.
And I think we've even worked on some deals where you were able to calculate like what's the best use of that money, whether it's a
Yeah.
2-1 or paying this down or whatever the case may be, right?
Right. Yeah. I have found that you get more bang for your buck on strategizing in a way that maybe they can use that money for even a temporary 2-1 buy down or a
Hmm.
permanent rate buy down.
Oh yeah.
Well, every eighth of a percent, I mean, let's say an eighth of a percent costs $2,500. Okay. If you were to use, or if you were to take $2,500 off of the sales price, you might be saving $15 a month. If you drop your rate an eighth of a percent, you might be saving $30 a month. So when I strategize with the agent as well as the buyers, and we say, okay, what's the best usage of this money? 10 times out of 10, the buyer's like, okay, let's buy down the rate, pay the
Yeah.
closing costs, let's buy down the rate because
Yeah.
we save more. It's all
Exactly.
about affordability. It's that payment. The
Yeah.
payment is key. Rate is important because it drives the payment. But I think ultimately for a buyer, it's the payment. They're just, can I make that payment every month? If
And feel
so,
comfortable, not be house
exactly.
poor. Yeah.
Yeah. Yeah.
What are you seeing for interest rates right now? I know
Yeah.
being September 13th of 25, we just had a tick down recently.
Yeah, so rates right now are in the low sixes, high fives. Rates are driven by loan program, down payment amount, credit score. Okay, those are the big variables. But on average, we're seeing 6.125 to be pretty close, if not spot on, what is called the par rate. There's no
Yeah.
added cost to get that rate.
Yeah.
But there are people that are able to pay a little bit extra and actually get 5.99%. And there's something
It's been a long
psychological
time since we've
about
seen
that
that
five
rate.
versus the six.
Yeah.
So yeah, we have not seen this in over a year in
Yeah.
this range. And it's one of those where it brings more buyers into the market because now that house is more
More
affordable.
affordable. Yeah. Um, you mentioned kind of the Fed rate. I
Mm-hmm.
know you sent an email recently about the Fed rate, and from the political side, we're all hearing the president's telling the Fed chair, lower the rate, lower the rate, lower the rate. But you were kind of shared some insights that that's not exactly how it necessarily works. It's involved, but can you share
Yeah,
a little bit
yeah, it's
more?
definitely it's not an indirect, or it doesn't directly impact rates. Indirectly it can. It most definitely does.
Yeah.
Because what happens is the market, so mortgage rates are driven by mortgage-backed securities in the bond market. So it's just in the market, stock market, bond market, people invest in those.
Mm-hmm.
And so what takes place is typically with mortgage rates, it moves in anticipation of an event. So the Federal Reserve is meeting next Wednesday. It is anticipated they're going to cut their rate 100% at this point. And the anticipation right now is a 25% basis point cut
Okay.
to their federal funds rate. The mortgage rates have already moved in the direction that they figure that's happening.
Yeah.
So,
It's kind of like stocks, if you will, that
yeah,
perceived value of money.
absolutely.
Apple recently announced their new iPhones that, likely that's going to be an increase in Apple's business and sales, that likely the stock ticks up a little bit as well.
Yeah,
Yeah.
absolutely. Just the same thing. It moves in anticipation of that. So we've seen a drop in mortgage rates over the last 60 days, more so even in the last 14 days, where we gained another 3/8 to a half of a percent.
Yeah.
And so the market is already shifting in anticipation of that happening next week. So then what will happen is that the market's next move will be dependent upon what does the Fed say about future rate cuts?
Yeah.
How does inflation look? How does unemployment, what are those doing as well? So that's why it's always so tricky to know what the rate market's going to do
Yeah.
because there's all these little variables, but it's already moving in advance. So people that are waiting for mortgage rates to drop further next week after the Fed announces, there's no guarantee they will.
Yeah.
And so they just need to anticipate it's just very difficult. Well, they need to know it's very difficult to time the market.
And right, I always tell folks it's never a bad time to own real estate, because a lot of
Mm.
people are like, when should I buy? When should I buy? It's never a bad time to own real estate. Sure, you can try and time the market, as we hear people do, where, oh, the interest rates dropped a little bit or prices dropped a little bit. It ends
Mm.
up you're saving pennies at that point. Sure, if that's what you
Absolutely.
want to do.
Yeah.
But we've talked a little bit about like interest rate and all these now more buyers coming into the market.
Yeah.
With that increased competition, it's that basic supply and demand. We see home prices now increasing. So sure, you've waited a little bit to get that, 0.5%, 1% lower interest rate, but now you're paying potentially 50,000 or more for the
Mhm.
home. So there's not necessarily right or wrong, but
Yeah.
which do you want to do? Which is your
Right.
preferred
Well,
choice, Yeah.
and that's why I always advise clients, even if they're just thinking maybe we buy this next year or 2 years for that matter,
Yeah.
is to just when they feel comfortable enough, get in to see a mortgage professional sooner
Yep.
than later to kind of just see what's there because It comes down to the math, and it comes down to what we talked about already, which is affordability. If someone were to buy a home right now for 500,000 and their rate was 6.125, or if they said, hey, the alternative is I'm going to wait for rates to drop one full point. When they get to 5.125, call me up, Kevin, and I'm going to go buy a home. The difference in that is typically in a situation like that, once rates come down in the fives, everyone's jumping in the market,
Yeah.
right? And
Yep.
so now you got competition. Now all of a sudden that house of 500,000 has been driven up to 550
Yeah.
just because of demand.
Yep.
If you buy a house at 550 at 5.125 versus 500,000 at 6.125, your payment on the 5.125 house
Mm-hmm.
or rate
Yeah.
is $41 less. That's
Okay.
it.
Yeah.
So
So
you're
you waited all
waiting
that time to pay more to only save $40.
Exactly right.
Yeah.
Yeah. And I think a lot of home buyers they don't really understand the math because they don't live in this world.
Yeah.
So that's why a mortgage professional is helpful to let them see the numbers, because most of the people, when they see that and they're like, wait a minute, I'm only going to save $40. I mean, to me, saving $40, I would rather buy now and gain $50,000 in equity when the
Exactly.
market goes crazy
Exactly.
versus saying, oh, I saved $40.
Yeah.
Because here's the alternative as well. Not the alternative, but if they purchase now
Mm-hmm.
and their home is 500,000 and their rate is 6.125. If in a year, 2 years, 3 years, whenever that rate gets to 5.125, and they were able to say, hey, it's a full point drop, we're going to refinance
Yeah.
at that lower price, now the lower rate, the savings on that monthly payment from their original payment, $290.
And I love mortgage brokers like you, where you guys will do all those calculations to say, A, does it make sense to refi? Because there's a couple costs involved with that.
Mhm.
You know, what is that savings? What's that time frame that it's going to cost to recoup those savings based on the decrease of payments, decrease of interest, all of that. And you also mentioned getting with a mortgage professional if you're even considering possibly buying, because I know you and I have worked together on a few things where
Mhm.
you're able to kind of build a profile of somebody, not even pull their credit, just to kind of initial, no pressure, just kind of see where things are at. And a couple of my clients you've even worked with on like what credit repair things or what to
Yeah.
pay off to make a rate better because your credit score is higher. Like that's
Yeah,
such a little Tetris game, if you will, right?
absolutely.
Yeah.
I've went away from the title of like loan officer to more mortgage consultant, because I
Okay.
feel like that's what we are and that's
Yeah.
what we should be.
Yeah.
And so we are going through trying to build a specific financial setup for our client to give them the most success when buying a home.
Yeah.
Monthly payment, everything. We want them to be successful. We believe we're their mortgage consultant for life. At least
Yeah.
we hope so.
Yeah.
So.
Well, thanks for joining us today. If you have any questions, feel free to reach out. Thanks.